Okay, let's unpack this. If you're looking to invest in a growing tech sector, the immediate thought is always back at the market leader, the company with the biggest name, the deepest pockets, the clearest dominance. In the global ride-hailing space, well, that's Uber.
Yeah, it's the standard playbook, isn't it?
Yeah,
You buy the biggest fish, they've got the resources to handle pretty much anything and keep expanding. Market dominance often just gets equated with superior returns.
Exactly. But today, we're kind of challenging that assumption. We dove into a stack of financial sources, actually, that present a really compelling case that the number two player, Lyft, is arguably the stronger investment opportunity right now, and that's based purely on its potential for superior percentage returns. So our mission today is to really dissect the logic behind this idea, focusing not on the absolute size, but more on the relative growth dynamics.
And that relative perspective is absolutely everything here. We're really analyzing the specific mechanics of the North American ride-hailing industry. Uber is, well, it's a massive, multifaceted global company, while Lyft, on the other hand, is showing a growth trajectory that could be far more impactful relative to its current, much smaller base.
Right. So to really grasp how bold this investment idea is, we have to start by just acknowledging the huge difference in scale. I mean, the gap between these two companies it's pretty staggering.
It really is. Lyft launched commercially back in 2012, just a couple of years after Uber. But that difference in timing and their subsequent strategies created this massive financial gulf. The research we looked through shows Lyft's 2024 revenue projection sitting around, what, $5.8 billion?
$5.8 billion. Okay. Compare that to Uber.
Yeah, Uber is projected at $44 billion.
Wow. $44 billion. Okay, now that $44 billion for Uber, that reflects their global operations, right? And the fact they're huge in delivery, too. But even if we kind of strip that back and just look purely at the U.S. ride-hailing market, where Lyft has traditionally focused, the difference is still enormous, isn't it?
Oh, the domestic market is definitely Uber country. Analyst data we saw suggests that even just within the core U.S. ride-hailing scene, Uber accounts for roughly 3/4 of all the activity, which leaves Lyft with just, 1/4.
3/4 to 1/4, okay.
What's fascinating here, though, is that the discussion isn't really about whether Lyft can ever overtake Uber. That's probably not the point. It's more about comparing Lyft's potential percentage growth in the future to its comparatively tiny situation right now.
So if Uber controls 3 times the market share, why are some sources pushing the number 2 player, Lyft, as the better stock opportunity? The logic seems to hinge on some very recent financial momentum, something that's changed their structural profitability.
Yeah, that's exactly it.
Because for the better part of a decade, the whole story of ride-hailing was just burning cash, right? Racing for scale. But Lyft recently hit this really critical financial milestone, one that fundamentally shifts their outlook.
That milestone was swinging to a full-year profit just last year. And this is, well, it's profound, really. It means Lyft finally reached what analysts call critical mass, where their scale, their self-sustaining scale, is finally large enough to fully cover all their fixed costs. Things like technology, corporate overhead, and their variable costs, too. They basically prove the model can work financially, which, immediately opens the door to greater efficiency down the line.
Okay, but hold on. Is just hitting profitability enough? Uber's been profitable for longer, hasn't it? And their margin is still often better. Plus, they've got that massive delivery division to smooth out any bad quarters in ride-sharing. Doesn't this just mean Lyft is, less bad, not necessarily a superior investment?
That's where the concept of operating leverage really comes into play. See, since Lyft has just reached that critical mass point, any incremental revenue they earn now tends to fall to the bottom line much faster. That's the definition of leverage, basically. Their fixed costs are already covered, so their profit margin rates are expected to widen, maybe disproportionately, as they expand. This momentum really sets the stage for future performance.
Okay, so the key takeaway for an investor who's focused on growth isn't just that they are profitable now, but it's the acceleration curve that comes with it.
Exactly. Our research shows that Lyft's revenue and earnings growth is expected to accelerate. And that trajectory, that upward curve, is anticipated to hold strong at least through 2027. Think about it. Uber, operating at $44 billion, needs exponentially more new revenue to achieve the same, say, 10% growth rate that Lyft can potentially achieve with relative ease off a $5.8 billion base. That acceleration is what makes the bullish argument, well, so compelling for some.
Right. So if that acceleration trajectory is the core argument, we need to understand how they plan to sustain that growth, especially against such a dominant competitor like Uber. And that's where their strategic pivots seem to come in. Let's start with that surprising international move they made.
Yeah, this is a huge departure from their traditional North American focus.
Yeah.
They recently made an acquisition that honestly seems tiny on paper. Europe's Freenow.
Tiny is definitely the word. The acquisition cost was only about $200 million, right? I mean, when you think about Uber's average M&A deal size, $200 million is almost small change. And it's mainly a taxi-oriented service, too, not pure ride-hailing like we think of it here.
Uh-huh. But what's fascinating here is that the low acquisition cost is arguably the strategic advantage. The research we looked at highlights that Freenow currently serves less than 1% of Europe's total personal mobility market.
Less than 1%. Wow.
Yeah. That represents an enormous potential upside for market penetration. So Lyft isn't going head-to-head with Uber's existing massive infrastructure in Europe, not directly anyway. They're acquiring a local player, Freenow, which has huge potential to scale up within a pretty fragmented European market.
Okay, so the strategic thinking seems twofold then. One, they're kind of avoiding Uber's established battlegrounds, picking a different fight. And two, because Lyft's overall market cap is so much smaller than Uber's, any successful scaling of Freenow will have a dramatically greater percentage impact on Lyft's total revenue and earnings. It's that leverage idea again, but applied to M&A.
Absolutely. It's exactly that. The proportional impact of, say, a $100 million revenue bump on a $5 billion company is just far, far higher than the same bump on a $40 billion company. This ability to make these high-impact but lower-cost deals could be seen as a competitive edge, one that's almost inherent to being the number two player.
Interesting. Okay, beyond Freenow, what other levers are they pulling to drive this growth?
Well, they're building some pretty intriguing partnerships. They're working with China's Baidu, for example, on developing autonomous vehicles, specifically for the European market. That signals a definite long-term future focus. They also have significant commercial partnerships with MasterCard, DoorDash, and, starting next year apparently, a new relationship with United Airlines that's expected to directly add to their top-line numbers.
I also noticed the source material pointed to a specific, almost surgical domestic strategy too, which seems to contrast pretty sharply with Uber's sort of blanket, conquer everywhere approach.
Yes, exactly. They don't seem to be trying to fight costly market share battles in places like New York or LA head-on. Instead, the strategy appears to be focusing on underserved major U.S. cities. The sources mentioned places like Indianapolis and Nashville, for instance, as places where Lyft is already achieving above-average growth rates. This suggests they're picking growth battles they think they can win more cost-effectively, maximizing their impact in areas where maybe the competitive saturation is lower or perhaps the regulatory environments are a bit more favorable.
Okay, so that paints a picture of potential, but
Yeah.
despite all these growth levers and strategic moves, we really have to pull back and acknowledge the vulnerability here, right? Lyft's size is still a risk factor, and we need to be objective about the competition.
Oh, absolutely. We must. Lyft simply doesn't have the resource cushion that Uber does. And it's essential to remember that in the last reported quarter, Uber still reported higher revenue growth and higher rider growth, at least in raw dollar terms. So in terms of sheer magnitude, Uber is currently outgrowing Lyft.
And furthermore, for anyone looking at Lyft's stock right now, there's a very real concern about its current valuation, isn't there?
After this enormous run-up over the last year, the shares are, well, kind of curiously trading significantly above what analysts expect.
And this raises a really important question for potential investors. Should you maybe wait for a dip before diving in? The analyst commentary we reviewed noted that the consensus price target, which is, the average price analysts think the stock should be worth over the next 12 months or so, is currently around $16.80. $16.80. Okay. And the current price mentioned in the source.
Around $22.66.
Wow, that's a huge gap, over 30% higher than the target.
It is. And that disparity suggests there's considerable skepticism, at least in the analyst community, about the immediate near-term upside. The majority of analysts currently rate Lyft stock only as a hold right now, primarily because the stock seems to have run ahead of the current fundamental expectations. It feels like the market might already be pricing in that anticipated 2027 acceleration today.
Okay, so the investment thesis really requires a high degree of patience then, and a strong belief that those longer-term strategic moves, the operating leverage kicking in, the Freenow deal paying off, will eventually justify this premium valuation.
That seems to be the crux of it, yes. It's a longer-term story.
So wrapping this up, what does this all mean for the investor who's focused on the long game? The bigger context is the industry itself. right? It's still growing rapidly. The research by Mortar Intelligence we saw predicts that the whole ride-hailing total addressable market, or TAM, will grow at a massive 16.6% average annualized rate right through 2030. I mean, that's a sector you probably want some exposure to.
Indeed, that's a strong tailwind for everyone involved. And while Lyft may, never actually lead the market, it seems to have figured out how to be a, let's say, cost-effectively competitive second-place name.
Hmm.
And in a market that's expanding at nearly 17% annually, being the most efficient competitor, even in second place, well, that still translates into potentially tremendous opportunity for long-term holders.
So the core thesis really demands shrugging off that short-term stock price volatility and maybe the curt hold ratings and focusing instead on a 5-year, maybe even a 10-year time frame,
Yeah.
where that acceleration enabled by operating leverage and these strategic pivots can really start to compound.
It's exactly. It's entirely a game of betting on relative growth potential versus just backing absolute scale.
Which leads us, I think, to our final thought for you, the listener, to mull over. Is the ability to leverage a smaller footprint for maximum relative percentage impact, like that tiny, almost insignificant seeming Freenow acquisition potentially leading to massive European penetration upside. Is that the true competitive edge in a hypergrowth industry like this, even when you're facing the, frankly, unparalleled resource dominance of a giant like Uber?